Welcome back. It's time for Building Real Wealth. Okay, this is interesting to me. Confidence doesn't come from the market. Okay,
Right.
Denise, what are we
Yes.
talking about here?
Well, it's kind of funny. When the stock market is doing well,
Mm-hmm.
it's amazing how confident and how happy everybody is. You open your retirement account, the balance is
Yippee.
going up, everybody's so happy, the headlines are optimistic, and, retirement, man, that feels easy.
No
I got
problem.
this, and then the markets drop. And the headlines change, and your account balances shrink, and all of a sudden, people start asking, "Can I still retire? Can I afford to retire? Should I move all my investments to cash?" And what's interesting is that in many cases, it wasn't their long-term plan that changed; it was the market.
Yep.
So today we're going to talk about something we believe is incredibly important. Why confidence shouldn't come from the market. It should come from your plan.
Very good. The market is a terrible source of confidence. That's true. Caleb, I think we would all be just at the edge of our nerves if we just looked at the market all the time for that, right?
Markets are emotional. Like Denise said, they go up and down. And kind of her point, markets are relatively close to all-time highs, but
Yeah.
maybe the headlines lately aren't so optimistic and things like that. So it's, for investors, how do you square those things if you just get your confidence, or is this all going to work just based on market metrics? When we meet with clients, we kind of ask, what's changed in your life over the year just based on the market performance? And a lot of times the answer is nothing. Nothing has changed in my day-to-day life based on the market performance up or down. I can maybe do a little more, do a little less, but really on the margins, it's not that impactful in the context of their whole plan. They still have the same goals, the same family, the same retirement timeline, the same spending habits, And the only thing that's changed is that, price of their investments, which again can be a very important factor, but it shouldn't be the sole reason of that confidence. So that first myth is, if the markets drop, my retirement plan has failed. And, in our view, that's why we do retirement planning. A retirement plan should assume or take into account some of those market fluctuations, some of those market drops. It's not all, straight up. And, that's not the flaw of planning. That's the reality, again, of just how the markets work anyways, plus over your investing timeline. But, part of that overall plan, too, should be, how do you take advantage of that volatility? Part of it is, hey, if you've got confidence in the market, you can hopefully use that confidence in market downturns as well, too, of how do you take advantage of it as far as tax loss harvesting, rebalancing, additional contributions. So part of it is just reframing that in your mind, how I view the market and how do I get confidence out in. It's not so much of a performance based, how do I use it as part of that broader plan.
Markets will rise and markets will fall.
Yeah.
If you can plan for that, good deal.
Yeah, exactly. Well, and that's
Yeah.
the thing, none of us know the timing of that, but those are the other things, what you can control. We don't have control of the market, but we can control some of those other things. So, and yeah, if you're gaining confidence or anxiety about something you have no control over, that's part of that education that we talk to folks about. How do you first view the market in context of this plan and everything else?
All right. Confidence comes from income, not account balances. Do we make this mistake, Denise? Looking at the balance instead of what we might have to be concerned with?
Here's something that a lot of retirees discover after they quit working. Your account balance isn't what pays your bill, your income does.
Mm-hmm.
And so if you have two retirees and they both have $2 million invested, one has a clear income strategy. They know where every dollar they will spend is coming from. The other simply has an investment account. So who sleeps better at night? Usually it's the one that has a plan, that knows the amount of income they're going to be getting and coming in. And retirement isn't about having the biggest number. It's about creating reliable cash flow. And think about a farmer. A field may be worth a great deal of money, but its value alone doesn't pay this month's expenses. What matters is the income it produces over time. Retirement works much the same way. One of the biggest shifts people make is moving their thinking from an accumulator to thinking about dependable income.
Mm-hmm.
Well, and I would say, people have it on both sides. That we're talking about the overconfidence in the market returns too, but people also, as they near retirement, can have anxiety about still the market and, become too conservative too early. Or, hey, if you're overconfident, maybe you can stay too aggressive too late when you have that market downturn. So it's kind of both sides of it. How do you figure out that balance? And to me, not making success of your financial plan dependent on the market returns. Again,
Yes.
that's a component of it, but depending on that shouldn't be what makes or break your plan one year or the next.
To your point, Caleb, diversification. I might want to be all in those super aggressive stocks and exciting, but that's maybe not the best policy or the best decision for me, right? So talk about diversification.
Diversification is that mix of components, not only in just your investment portfolio, the actual stocks and bonds that you own, but also in your financial life, which is part of what we look at of the plan. Diversification is that different income sources. What are your different income sources in retirement? For most people, it's not just their investment portfolio. They have Social Security, they have IPERs, they have farm income, they have part-time income. It's their different investment types. Diversification of, do you have a Roth IRA and regular pre-tax IRA and a brokerage account? Those type of things. Real estate, things like that. So diversification is what allows people to stay invested during those difficult times, because you can point to one of those things. Kind of Denise's point, hey, if you're getting income from Social Security and a pension and don't need to draw anything from your investment portfolio, hey, then your plan shouldn't be shaking in confidence from a short-term market
Right.
downswing. And so, myth three is, confident investors never worry. That's not true. Confident investors worry like everyone else. Like they do, because we've talked about, there's headlines all the time that are worrisome that you look at. The difference is they just have a plan that keeps them from making those emotional decisions that are market-based rather than like lifestyle-based. Most people think about diversification when we say it just in the investment context.
Yeah.
How many stocks, bonds, or whatever do I own? Not, hey, is my income sources diversified? Is my risk diversified because I have life insurance and I still have debt and things like that too.
Confidence comes from having a plan for bad markets. Denise.
One of the questions we sometimes ask clients is, what happens if the market drops 20% next year? People are often surprised by that question, but we ask it because markets don't move in straight lines.
Right.
And if your retirement plan only works when everything goes right, it isn't much of a plan. A good retirement plan will anticipate setbacks. It accounts for volatility, it accounts for flexibility, and it gives you options. You think about preparing for winter. You don't go buy a snowblower the day it snows 1.5 feet and you need a snowblower. You don't go buy ice melt after the, well, you probably do. I think a lot of people do go buy ice melt after it ices, but you prepare for things before you need them. And retirement planning works the same way. Confidence doesn't come from believing bad markets won't happen. It comes from knowing what you'll do when they do come along. And, this leads to myth number 4, which is, I'll just figure it out if the market does crash. Because making important financial decisions during periods of fear hardly ever produces a great income. And planning ahead almost always beats reacting later.
Yes, absolutely. You want to have your snow thrower with fresh gas tuned up and ready to go. No more ice melt sitting there ready to go.
Yeah.
Prior to.
Yeah. Confidence comes from knowing what you can control. To your point, Caleb. So talk to me about that.
Yeah, well, because really at the end of the day, that is what we try to preach to clients, teach them and stuff too, because again, with investments too, that's not most people's main focus. That's not their forte, but they do have a lot more control over it than they think. Because markets move, interest rates moves, they'll change, inflation will fluctuate, tax laws will evolve. Again, us as advisors, we're on it, we watch it, but we don't control those things. To some of that we do have to react to or help clients react to. But part of that is having that plan, and those things that are outside of your control. Those are the things outside, but inside your control, we can control how much we spend. What is the timeline that me and my spouse are going to retire? How are your investments allocated? The tax planning, the Social Security timing, healthcare timing and paying for healthcare, charitable giving, legacy planning. There's a long list of those things. One of the healthiest shifts people can make is focusing less on predicting the markets and more in controlling those decisions that influence it over time. So myth 5 is confident investors know what the market is going to do next. No, nobody knows what the market's going to do next. They just know what they're playing, what they will do next.
Right.
When whatever that market situation. That's how I think about it. Hey,
Good
we don't
point.
know what the market's going to do, but we have a plan for what we're going to do, whether it's up, sideways, down. This is how we'll react based on all these components, because that's where the confidence comes from. And us doing it over and over, we've seen a lot of market cycles, a lot of ups and downs for the headlines. And to Denise's point, the market in the last year and a half has had some 2 pretty significant declines, but it has come back. So it can either be a good thing or a bad thing to reinforce that anxiety or that overconfidence, but there is no straight line to it, and we kind of try to help people sit down, think about all those things, and demystify some of those myths or get confidence in their overall plan.
It's good information. Okay, Denise, wrap it up for me here.
You know what? Retirement can be chaos. I mean, it really can be. And, one of the things we've always said, I don't know that we've said it recently, but, one of the things we do is we turn chaos into clarity.
Yeah.
And, we try to do that. And our team does a fantastic job of sitting down with people and just having a cup of coffee, talking about what you all want, And another thing Dan Miller will say is, it's not about the money. The money makes things happen, but what about your life? What do you want to do? You got to have a plan.
Right.
And I think eliminating that chaos comes from having a plan, and basically helps you prepare and makes you feel a little more optimistic and not be so nervous, because like Caleb has said, the markets are going to change.
Yeah.
And so you have to control the things you can control. And that's what we really try to do. If your confidence depends on the market, then it's going to rise and fall every day, because it changes every day.
Yes.
And if your confidence comes from a well thought out financial plan, you'll have something much steadier to rely on.